Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike, Chris, and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike, Chris, and Al.
And it is Saturday, and we're going to be talking about money. You know, in times like these, with the market up, with the market down, times like these, there are things which seem so logical, so reasonable to do to keep from losing money. They seem so very good, and yet they don't work. And I just want to pick one of those right now to illustrate that whole point. It's called the stop loss. You listen to people on TV, they talk about buying a stock and put a stop loss 10% below or 15% below. Or you listen to some of the newsletter writers who say we put in stop losses to prevent losses. I think the whole key word of that is loss. And let me give you an example. Suppose you buy 100 shares of a $40 stock. Make the numbers really simple. You write a check for $4,000, or you take $4,000 in your account, and you own 100 shares of stock at $40 a share. And you decide, since you've listened to CNBC, or you've read in Barron's, or you've read other places where you should put a stop loss in, you put a stop loss 10% below the $40. So the most you can lose in that stock is $4. If it trades down to 36, you're out of it. And sure enough, you buy the stock at 40 and it goes to 36. And you're stopped out. You're left with 3,600. You started with 4,000, you now have 3,600. But as the day winds down, the stock then recovers and it goes all the way to 43. And you really like the stock, you'd like to own the stock, so you buy it at 43. So the question is, do you really own the stock at 43? No, because in order to buy the stock at 43, you had to take the 3,600 that you got from being stopped out and add an additional 700 to it to get to 43. So you've now, out of pocket, you're out the original 4,000 and another 700. So that stock which you think you bought at 43, you actually bought at 47. You know, at 48, that original stock would have been up 20%. At 48, it's not even 5%. Think about that. Stop losses. And when I started in this business, I did try stop losses. And what I found is a lot of times you get stopped out on the same day. And if not the same day, later on. Half the times, maybe a little over half the time, stocks move up after you buy them, and half the time they move down. And that half time that they move down, you get stopped out. And it doesn't matter whether you buy a different stock or the same stock, it's the same thing. You just locked in a loss by using a stop loss. It doesn't prevent the loss, it locks in the loss. That's just one of the small points that's going on right now. And people think just because they've got stop losses, they're protected on the downside. But does it really, really work? I don't think so. I don't find anybody that's really using stop losses that's actually outperforming the market over the long term. And if you want to perform over the long term, it's not a matter of trading in or out.
Yeah, and we used to joke that stop losses were actually stop gains, right? Because especially in this market, how many times, and I for whatever reason, like Wednesdays stick out to me because I feel like a lot of the CPI data has come out on Wednesdays. How often does the market open up down 2.5%, 3%, and then something happens and then the day ends +1, right? Like there's these huge deviations we've been seeing in the last 8 to 10 months. And so to like your point, Mike, if you put in a stop and it hits first thing in the morning, and then in the afternoon you end up. It's how a lot of investors shoot themselves in the foot. So
They do shoot themselves in the foot.
yeah, so I really call it the stop gains. And what another, you brought this up earlier, things that work, kind of work on paper, but not necessarily in reality. And I always think of this one client, because he's always calling me up and he's like, this was 6 months ago. He said, you guys are in this business. You're always on the news, looking at things. Shouldn't you have known that, kind of a downturn was coming? Shouldn't you have known that some negativity was coming into the market? And I look at him, I'm like, well, if I had a crystal ball, yeah, I would have pulled you out, but I don't, right? Like it's all about the time in the market, not timing the market. And so naturally I bring up this stat, and it's one that a lot of advisors talk about. It's something that, Al and Mike have just shown to me, and it's missing the best trading days in the market. And, let's say that there's a couple of studies that do this. If you Google it, you'll find a bunch of different ones ranging in a number of different time periods, from either 2000 to 2020 or from, 1927 to 2015. But I'm going to use the one from 1927 to 2015, because I believe the S&P 500 started in 1927. Is that correct?
I think 1920 or 22, but it does make a lot of difference.
Close enough. Right.
Before I was born. And I'm really old.
Oh, so here we go. So let's say that you invested just $1 in the S&P 500 on December 31st, 1927, just a couple of years before it gets really bad, right? If you had stayed invested the entire time, bought and held, right, your ending value would be about $115. So $1 turned into $115, right? Now, if you had missed the 10 best days, right, that value instead of 115 would be 38, right? But if you missed the 10 worst, that would be $362 instead of 115, right? So there's these big deviations, right? And a lot of people are like, well, if you're in the business, you should be able to, figure out when the 10 best and 10 worst are. Well, that's not how it works at all. A very interesting stat that I saw right here was that 6 of the best 10 days occurred within 2 weeks of the 10 worst days. I'm going to say that one more time. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. And I'm looking at a chart right now. I wish we had video so you all could see, but there's green dots and there's red dots, and it's a volatility chart over the last 50 some years. And if you look at it, every single green dot is followed by a red dot. And then the red dots are followed by the green dots. And I think there's only 1 year on here in which it was just a couple of green dots with no red. So my point is, if you're going to try to time the market, a lot of the best and worst trading days are going to be very close to one another. And so to try and time it is not only risky, you're not only going to pay more trading commissions, you're not only going to pay more in taxes, there's a lot that's going to happen, but to time it is basically impossible, and I still have yet to see anyone that's done it successfully. So,
and I can remember one New Year's Eve when the market just caved in.
Wasn't that 2018?
I think 2018.
Yeah.
It just caved in.
Yeah.
And the day after Christmas, it was one of the best trading days of the last century.
So, Mike, let's pretend for a second that you are a trader, right? Let's put on your little trader cap for a second, right? On December 24th, 2018, what are you doing as a trader? Are you sitting at your desk? You actually probably would be, but for most people, are you sitting at your desk trading on New Year's Eve? Or are you with family enjoying, a nice Christmas celebration with turkey and, I don't know what you eat for Christmas, Al, but, what do you eat for Christmas? Do you have a tradition?
Turkey, like everyone else.
Okay, there you go. Yeah, turkey. I didn't know what.
For Christmas? No, wait, that Thanksgiving. Christmas, it varies every year.
Okay, I could see you having a lot of tradition on Christmas. I don't know. But my point is, you're not trading, right? You're doing anything but that. And then on the 26th, when things rebound, the second most volatile day, right? When you get a lot of your gains back, you're probably not trading, right? And so to think in a very human manner that you're going to be sitting next to your desk, timing the market perfectly, right? When you're probably going to be with family and loved ones, it just does not make sense. And it just doesn't make sense.
Doesn't make sense. And yet that was one of the worst trading days ever and one of the best trading days ever. And how do you figure that out?
I didn't look at it, Mike, but I think the volume around those times is actually a lot lower too, isn't it? In the holidays and
It tends to be lower.
tends to
during
be
that
lower
time
volume.
too. Yeah.
Yeah.
Because most people are not.
Not right. Not sitting
sitting there
Not sitting at the
trading.
desk.
And you need to be. If you're going to be timing the market, there's no days off, as they say.
And, and there's only been one or two guys that have done it. There have been a couple guys, and we've talked about it before. It was Jim Simons in his Renaissance Technology Fund. It averaged 66% from like 1988 to 2020. But it's one guy out of the millions have tried it. And how many people went broke?
Yeah.
Trying it? We can list the people that missed the market and went broke, right? I mean, long-term capital management, just keep going on and on. That caused, there was the Asian crisis. There was the peso crisis in '94, right? They go on and
The
on. Russian ruble, exactly.
Value. Yeah.
And then you talked about the nickel, the guy with the nickel crisis. Nickel, not nickels. The nickel is the element. I mean, it goes on and on. The people tried to time the market and just fell flat in their face.
It just doesn't work.
Or when you think about it, just recently the railroad strike. Had that happened, that would have tanked the market.
And so think about
do
the
you
news
sell
that
out before?
Exactly.
And then on the day a negotiation is reached, you're back in?
You know, the efficient market hypothesis, right? Was everything priced in then? Like, you didn't know that there was going to be, that they were going to not strike, right?
Yeah.
So if you place your stop losses then, and then the market, recovers a little bit.
Yeah. And there's another aspect. Most people, I use the stop loss. Most people don't judge their portfolio compared to something else. They think, in my example, they bought the stock at 40, it went out at 36, they buy back at 43. They think in their minds, I own the stock at 43. They don't think I really own it at 47. They don't judge that based on any comparable. They don't look at their portfolio compared to the Standard & Poor's 500 or whatever else they want to compare it to.
No, we talked about that with the mutual funds a month ago, 6 weeks ago, right?
About Money with Mike Adams on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com.
We were just talking about the mutual funds. We're talking about returns and how S&P, how people don't compare that to the bench. They don't compare it to the benchmark, which is the S&P 500. Right? How many benchmarks did we say there were, Mike, the other day?
There's over 3 million benchmarks.
Yeah.
Isn't there one new every day? There's a new one every day?
No, every time a money manager underperforms the market a couple years in a row, they come up with a new index to explain how they're beating that index.
So, when we talked about the mutual funds 7 weeks ago, we mentioned that the way mutual funds are calculating their returns, right, is they're not just looking at the benchmarking against the S&P 500. A lot of times what they're doing is saying, how much money have they taken in, adding that's how they're benchmarking their returns against how much money they're taking in, not necessarily how well the mutual fund is doing.
Yeah. I mean, we talked about that in some detail.
We did. And, you have some examples here of, people's perception versus reality, right?
Oh, yeah. And perception. I mean, I'm always reminded when people talk about perception about the question that's asked when you have a group of people and you say, how many people are better than average drivers? 75% of the people will raise their hand. And I'm in that group. I raise my hand. If I don't know if I'm really a better than average driver. The looks on your faces tell me I'm probably not.
Well, Chris told me about driving with you.
Sometimes don't like stopping at red lights.
He doesn't like stopping at red lights or stop losses. So.
Oh, if you see a stop sign, you don't believe everything you read, do you?
No,
Yeah.
The same thing was applied. Jackson National Life, back in 2012, did a survey of financial advisors, and they asked, how many of you outperform the market? 75% said, I outperform the market. 75%. Ask them if they're better than average driver, 75%. Outperform the market, 75%. How can that be? How can it be? Number one, there can't be more than 50% just mathematically. But 75%. But when Jackson National Life completed the study, they looked at how advisors did. And over that 2-year time period, and it's an old study, but it's still worth talking about, over that 2-year time period of 2010, 2011, the total return for financial advisors was 4%. For the S&P 500, it was 17%. We happen to have a couple good years being at 27%, but it points out the fact that when you don't judge how you do against a real number, this is how I do, this is how the Standard & Poor's does.
Well, when we looked at the mutual funds, right, and when they were judged against the Standard & Poor's 500, what did they find? What is it? 75, 80% of them don't beat the market.
90%.
90%. Was it okay? 90%.
Wow. 90. Wow. Yeah.
90% don't beat the market, and we said they change the average life of a mutual fund guys. What is he? 6 months, 2 years, or something like that. They change management like crazy.
Yeah. And those are the professionals managing it.
Yeah.
Think about individuals trying to manage it or financial advisors. And the strange thing, think about it. We have a couple sports teams that are winning. Can you imagine the owner of a sports team deciding to hire a player and pay a huge contract based on how well he likes the player without ever looking at what the batting average is, without ever looking at how many strikeouts or how many passes are completed versus interceptions, how many fumbles, how many yards gained per carry? I just really like the person. And I can tell you, coming out of the big brokerage firms, the mantra was sell the relationship, not the performance. Sell the relationship. Make people like you. Make people want to stay with you, no matter how bad it is, except they don't add that last part. I add that last part.
It's a lot harder to fire a friend.
Yeah.
Yeah.
And I think the other thing that happens is they begin to set low expectations. Al, you talked to somebody.
Yeah, this week, and 2 people actually. And he talked to his person at this other firm that he had his money with, and they said in his 401k he can expect a 3% rate of return. So that's what his benchmark is, 3%. I said, well, that's easy. We can, I could put you in T-bills right now and get better than 3%.
Yeah.
And so that's the benchmark they set for people. And so
who set the benchmark?
Which company?
Yeah.
It was Fidelity.
Yeah.
Classic.
And why did they set it so low?
It's easy. He said to me, well, if I get 5%, woohoo, they look like a hero. Yeah, of course.
Yeah.
Right?
The one that always gets me is some people are like, oh, I'm internationally invested, and so I need an international benchmark, so I'm going to use the MSCI, which is significantly, underperformed the S&P. Well, if you look at their portfolio, they usually have like 1 or 2 holdings, right? So is it really... It's sneaky. It's sneaky the way they use some of these indexes.
And the other guy I talked to this week, just yesterday as a matter of fact, he said the fees he was paying were more expensive than us. And we're not the cheapest haircut on the street, right?
No.
But he was paying more than we charge 2%, and there are people that charge more than we do. He was paying more than we charge, and his whole portfolio was based off of, we just don't want to lose as much as the market, right? It's basically a stop-loss portfolio. If the market goes down 30%, well, my portfolio is only around 20%. Yeah, but you're still out 20%. And when the market comes back, what's going to happen? Are you going to go up 20% or 30%? No. You're probably going to go up 2% or maybe 3%. So now you've compounded your loss because you're down, the market's down 30, you're down 20, and now you're up 3%. So now and the market went up 30%. So now you got a what's the math on 30 and 17? You're down 47%.
Yep.
47%. And people don't look at that. They go, they just think, I only lost this much amount. No.
So I'm doing well.
Yeah, I'm doing well. Yeah. And on top of the fees he was paying directly to the advisor, he had some funds in there, and I looked at the funds. I did an analysis of all the funds and ETFs, and the ETFs were fine, but still they have trading costs and slippage and all the other costs associated with doing the trading, market impact, market what do we call them, soft dollar cost, all those type of costs. But he had some mutual funds. Some of them had a 3.25% front end load, and they were 12B1 fees. So he's paying. I said, look at those funds. You're paying another 3 to probably 3.5%. So you actually pay total cost all in there is probably 6%.
And that's not even custom to you. I mean, that's managed for the masses, not the individual,
No,
right?
we know that they don't mention anything on. If you look at their website, they don't mention anything about picking investments. They mention all this stuff about, we're building a retirement, we're building a plan for you and a plan for the future and a plan for this. Nothing about returns, nothing about that, right? So they have the wholesalers coming in there because they're not the clients, right? We're the clients of the wholesalers, and the wholesalers come and sell us on what we should be telling our clients. So they just get on the phone and, hey, here's the guy's stuff. Put him in a portfolio.
Investing in funds is like hopping on the bus instead of taking an Uber. The bus is going to go where it's going to go. It's on its route. You're going to follow the prospectus. But, if you want to get to a certain destination, you're going to hop in an Uber, something that's custom to you, something that's going to go exactly where you want it to go. So
it's a good analogy.
I just came up with that. I thought it was pretty good, so I just wanted to huck it out there.
How long you been sitting on that one?
About 3 minutes.
That's long to hold in your brain.
Oh, man.
Oh, yes. It is fun.
I think the one that gets me, and I know we were going to bring this up a little later, but the moving averages.
Oh, yeah.
It's and I was looking this morning. Here I am just spewing off all the stuff that I was looking at this morning. But, I saw this, it was on this one page, and it was the unintelligent investor, right? And so the name had me, so I spent, 10 minutes looking through it. And it's amazing how many people prescribe to this method. But essentially what they do is they buy the S&P 500, and if it's above the 200-day, they own it. And as soon as the S&P closes below the 200-day moving average, then they switch the entire portfolio over to Barclay, basically a bond, right? And then once the S&P crosses that line, that 200-day moving average again, now it's equity time again. And so it's this constant going back and forth.
Well, that's just like the commercials you hear on the radio, Mike. Now you hear, if you listen to AM, you hear financial advisors, right? And then what are they touting now? We got portfolios that'll beat the inflation, right? Inflation beating portfolios, and how risky bonds are. And everything. And I heard just this morning on Bloomberg was Jeffrey Gundlach. If you don't know who he is, he runs a company called Double Line Capital, about $140 billion. He's the new bond king over Bill Gross. But he was saying that
he's extremely negative.
No, and he was positive. No, he said this morning he was not negative. He was saying that he thinks the Fed is being overly too aggressive right now. He thinks the long term, of course he's a bond guy, so he wants bond prices probably up. I don't know, but he was saying that he thinks long term the problem isn't inflation but deflation long term.
It's interesting.
It is interesting. It was an interesting perspective, and he's a really smart guy. I think he was a math major too, Mike. You get along good with him.
So let's come back to this moving average, because I see a lot of that too. In moving averages, you take 200 days, and they're all weighted equally. So recently we had the railroad strike that was going to happen. But you're weighting that average along with something that happened 200 days ago, or 70 days ago, or 112 days ago. So you're giving equal weight to every single bit of information.
Russia hadn't even invaded 200 days ago, right?
That's true.
Yeah,
That's true. I mean, think of September 11th, right? How do you evaluate the 200-day moving average around September 11th? You have one day where the spike in the VIX probably hit 75.
So moving averages have an important part in smoothing out a very volatile trend. So if you have a lot of volatility with a lot of data, a moving average will help you smooth out a trend, and you can see a trend, and you can see things are going bad, or you can see things that are going good. But to actually use the moving average, the 50-day moving average, cross the 200-day moving average, and so we're in for a really good time.
The death cross.
Yeah, the death cross.
I mean, it's like, I can remember if the NFL beat the AFL in football, it meant good things for the market, or vice versa. I don't remember.
Yeah.
Or the market, if skirts got shorter, the market was going up. If skirts got longer, the market was going down. I mean, Those were actual. I mean, going back to the 1960s and 70s.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike, Chris, and Al.
So the other day I received the Northern Trust 2023 forecast. And I love Northern Trust because they do the same thing year after year. 2022, they came out with their forecast for how we were going to do in 2022. Market up 6%. 2023's report, market up 6%. You know, sometimes I think, well, in fact, I know I've never been wrong at forecasting the weather. Never, ever.
Never?
No.
No.
I can tell you it's going to snow in Seattle. I can't tell you the day. I can tell you it's going to be rain. I mean, someday the market is going to be up 6%. And Northern Trust is going to say, see, we told you.
Told you so.
I mean, the market's down almost 20% this year. Northern Trust said it was going to be up 6%. And I think there's a reason for them doing that. And they make this whole analysis on, and every year they have a different reason or set of reasons for it being up 6%. And every year it's up 6%. That's their forecast. I think there's a reason they do that. And that is something we started to talk about, Al, setting expectations.
Yep. Sounds like my father when he came home from the racetrack. How'd you do at the racetrack? I broke even every day. Okay. You break even lose or break even win? I never got an answer. So.
It is. It's a way to set expectations. If you believe you're only going to get 6% and you get 9%, what's the feeling?
Euphoria, right? Like my client, like, right? If he gets 6%, he's thrilled because he's only expecting 3%. And so that's why we talked about that when we did a whole show a couple months back on forecasting and how forecasting is wrong. We talked about Kudlow and Kramer and we talked about, as a whole, Howard Marks as a whole he's from Oak Tree Capital. If you don't know who he is, he runs about $140 million distressed debt fund. And he goes on a whole hour long about how he does not pay attention to any economic forecasting at all. And if he doesn't pay attention to it, and he's one of the greatest investors out there, how much weight can you put on it?
So what do you think, Chris?
I don't know. I always think, it sounds good on paper, but it doesn't actually work. I always think of, when I say this, I always think of things that look good on paper. I think of that client, that's always harassed me. Why didn't you get out of the market? I always tell them this example, actually. We're in the Seattle area, so I go back to this. Let's go back to 2008 for a second, and it's not even, the downturn. Let's look at a team that had, Richie Sexton on it. Adrian Beltre, Felix Hernandez, just signed Eric Bedard, up-and-comers like Matt Tuiasosopo, Jeff Clement, right? A team that one of very few teams, I think one of like 6 teams that spent over $100 million that year, right? You would think, because on paper they're spending all this money, that they would do well. But in reality, this team ends up, losing 100 and some games, even though they spent $100 million. And of course, I'm talking about the 2008 Seattle Mariners. And then meanwhile, the Rays go to the World Series spending $43 billion, but I'm not going to go into that. My point is,
I don't know if you remember I can't remember the year, but it was one year the Lakers decided to stack the deck, and they had Shaq and they had Gary Payton. They had this dream team of players, and they were supposed to beat the snot out of everybody. And here comes this scrappy team from Detroit in the finals and just beat the snot out of them every game because those guys none of them can get along. And they're all fighting with who could the ball and who could shoot the ball every single time.
But on paper, it looked like it would work. It looked great.
It looked great, yeah.
Stop losses. Yo, get out of the market. There's a lot of volatility. We don't need to be there. It looks great. It looks great on paper. But as we know, it doesn't win you games.
Yeah, see, the market will come up with great names and great titles to get people captured. They'll change like everything. Oh, we got like I just said a little while ago, is we have portfolios that'll beat inflation, right? And then managed volatility funds. Okay, what's that? Managed volatility. I think one guy, I can't remember, one money manager I was reading, he said volatility is what it is. It's volatility. If you don't want volatility, Go buy T-bills.
How many keywords can we put in the front of this mutual fund?
How
to
can we
make it sound
sell? Yeah,
attractive?
how can we sell this portfolio? Let's see. Let's put something sexy in front of it that people capture people's eyes today. Inflation beating portfolio. You know,
And you're paying for it in your 12B1 fee, just so you know.
But what you said is right. It's the catchword. Inflation's the big word right now.
Uh-huh.
So you see things talking about doing well during inflationary times.
Stop losses.
and
right?
we spoke last week about the Inflation Reduction Act, which we all agree is not going to reduce inflation.
Yeah.
Or at least not very much, if
No,
it does.
if it does, it's not going to have hardly any impact.
No.
But inflation is the buzzword.
It is.
You know, during the Great Recession, it was safety was the buzzword.
Safety.
Safety. Put your money into a CD or put your money into an annuity. Put your money into something.
Well, that's when I started. I was still with I was with New York Life at the time, and that's their whole shtick. Is these insurance companies is selling that the markets, they would go out and tell people. I remember advisors going out and telling people in 2008, because that's when my contract triggered with them, is the market's never going to return 8 to 9% again. Put your money in a whole life contract, or put your money in an annuity and get you 2 or 3% and shut up.
And how good did all the annuity salesmen do? You know,
Oh, they killed it.
2009? Yeah.
They freaking killed it. You know, they had their best. The manager came in and everybody was glum because the market had dropped 40, 50%. I was like, oh, geez. He came in and said, you guys, this is going to be the best year and it was their best year. It was their best year they've ever had. And I'll guarantee you they're killing it again right now.
Yeah.
They are.
Because they're going out and selling people. And then when the market starts to return, they're going to go out and try to sell them, put them back into take the money when it's out of the annuity's out of its surrender and put it into a variable annuity, which has about a 7% load, and you're still going to lose money. So
No risk.
Oh, those, and like structured products that came out, you know,
oh yeah,
a guaranteed that zero risk.
zero risk. Well, they it was funny because they had a rider on their annuity, and you'll see the ads in the New York. I mean, in Barron's, they have a big ad in Barron's, and New York Life does, and they have a rider on their annuity. It's called a principal protection rider. So if you give them 100,000 and the market drops below 100,000, they'll give you your $100,000 back. So if it drops to 80,000, here's the caveat. That's got to be held over a 10-year period. Show me a 10-year period where the S&P 500 has been below where it started 10 years ago. It hasn't. I think from 2000 to 2012, it broke even or something like that. But it's never been had a 10-year period where it's been less.
Yeah.
Except for maybe the Great Depression, maybe. That's about it. But not in the last.
Even the Great Depression, because remember, that was one of the best performing times. I had a client, you know, when I first started in the business, who told me, well, the story is that he was on margin. He was 80 years old when he became a client, wanted to do margin. I was young and dumb and thought, oh, okay. You know, it doubles my trading commissions because we're trading twice as much stock for the same amount of money. But when the crash of 87 came, the market came tumbling down and there were margin calls. And I put off calling him that day. I knew I needed to call him on the Tuesday after the Monday. So it was late afternoon when I finally got a hold of him, when I finally
Worked up the nerve.
And I'm thinking, how could I be so stupid? 80 years old. This guy's going to yell at me. He's going to scream. He's going to sue me. He's going to do something. Who knows what he's going to do? And when I said we have margin calls, he laughed. One thing I never expected was him laughing. And he had a Thai voice like this. And he said, you know, I was on margin in 1929. I was on margin in 1931. I was on margin in 1937. And let me tell you, that market is percentage-wise the best market I've ever lived through. And I sat there in almost shock.
Weren't expecting that, yeah.
No, because all I'd heard is how everybody lost so much money during the Great Depression. Never buy stocks. You just lose money. So I looked at the charts, and sure enough, those returns were extraordinary.
From 29?
From 31.
From 31, yeah.
Yeah, so the market plunged in 29 and continued down to 31.
Yeah, and then it plunged again in 33, right, and then bounced
37.
back up. 33, didn't 33 it bounced too? I think it dropped to 33 too.
I don't remember that. You know, it's been a number of years. But
Yeah, you think?
he talked to me for like 2 hours and said, this is how you handle margin accounts. Do you know? It was probably one of the most valuable 2-hour lessons I've ever had. And he knew how to handle margin. He knew what to do. And I came away and wished I would have called him a lot earlier. I mean, but those are the things and the lessons you kind of learned during those periods of time.
You sure you hadn't just had a few?
No,
You said you waited till the end of the day.
I waited until the end of the day. I didn't have anything to drink, but
You might have.
it would have been a good idea.
Yeah. But naturally, you think of risk when you think of that, right? Someone that's lived through all these different, events, these huge downturns, it's surprising that, because we talk a lot about risk tolerance, and how that's always changing. And I know we're going to go into this into the next segment, but, an individual that can still have that mindset after, experiencing drawdowns of 60, 70%, 80% even.
Yeah. And sadly, he had a lot more money than I ever got to. So, I mean, but it all comes down to understanding risk and being willing to understand that the risk is being out of the market, not being in the market. It's understanding that, as you said, Chris, missing the 10 best trading days, cut your return in half. The studies that have been done, whether it was the Peter Lynch study or the Money Magazine study or the multitude of other studies that have been done. The Stock Traders Almanac publishes some of those studies. Missing the best 10 trading days, cut your return in half. And the difference between the best trading days and the worst trading days, you don't have to worry about missing the best trading days if you're fully invested. Missing the worst trading days, you have to guess right. Come into a commercial break, don't go away. We're going to finish this off, so we've got more to say.
About money with the AFC team, Mike, Chris, and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
Welcome back. Before we went to the break, we had talked a little bit about risk and how that's always changing. If you go into your financial advisor, you go into one of the big brokerage houses, what they'll do is they'll basically have you fill out a risk tolerance survey, right? And after filling that out and going through it and plugging it into the modules, they'll spew out, some sort of allocation in which you should have based off your age, how you answered that survey, the whole 9 yards, a litany of things. So what we talk about is, in 2008, if you had filled out one of these surveys, right, how would you respond to it based off everything that's going on right now, right? Well, you see your housing price, the value of your home plummeting, right? You see your retirement plummeting. You see, people foreclosing on their houses and people out on the street, right? You would probably say that I don't want that much risk, right? I don't want to be part of the market. It's too risky, right? And so you'd end up in some sort of allocation like, 30-70, right? But if you had asked that same question 5 years later, let's say in 2015, 2016, 2017, right? All of a sudden your answer to that question would drastically change, right? Because now we're in the middle of one of the longest bull markets that had ever taken place, right? You're seeing people that are getting double-digit returns. I think we even did 20-some% throughout that period, right? And so your tolerance would be completely different. And so you got to be really careful with a lot of individuals that go out and talk about these risks, because a lot of it depends on the time in which you're in. Like right now, if you're filling out one of these surveys and you're investing in the market for the very first time ever, you're probably going to be like, I don't want to take that much risk. And if you lock yourself in, to, a poor allocation, and you need growth, right? Maybe you haven't saved successfully for retirement. You're going to handcuff yourself to poor returns for quite a while. And so it all comes back to risk. How much are you willing to accept? And really, risk to me is more of an education question than anything. How much do you know about the market? Do you know that it's always going to recover? Do you know, that's what I think it really boils down to.
Yeah, I mean, the gentleman yesterday that I spoke with, when he talked about risk, and he talked about he inherited this money, and he had to take required minimum distributions out of the funds. But he still said to me, I need this for retirement. I still need it to grow. I said, well, the allocation you have, like we explained, basically trying to protect him from not having whatever the market does. Maybe he'll, the market drops 30, he's only going to lose 20. but he's not going to have the growth in the account, especially he's double dipping because he's taking money out of the account and the account's not growing. And let's step back on this. These questionnaires that they have us fill, what are these questionnaires for?
They protect the
They
firm.
protect the firm. They're a compliance question. Oh, we got to get this questionnaire. We got to get this 10-page questionnaire. The questions are ridiculous. Most people can't answer them. The question will be, if the S&P drops 10%, would you rather sell out of the market, go into bonds, hold cash, or something like that? And then they'll have another question, about do you want to be invested in technology? Do you want to be invested in, in international companies? And a lot of people look at them, they're like, they really don't have a rhyme or reason, but it's just something to protect the company. So that when they put them in the allocation, they put them in, this is what he filled out. They can run back and say that.
Yeah.
So the other day I get approached a number of times by firms trying to sell products. And one is a risk tolerance setup and like a form. And it showed basically what it did is it said, this is the risk you're taking and this is the expected return. So, and in the form, if you want to do a 10%, you're taking a 5% risk. If you want to do 20%, 10% risk. The reality is the form is so misleading because at any given time, the risk, if you want a 20% return, the risk on the downside is 40%. If you want a 10% return, the downside risk is 20%. 5% is 10%. This had it just reversed. I've been around the business a long time. And what I found is when people come in and the market is doing well, they have a high risk tolerance. When it's doing poorly, they have a low risk tolerance. And being a mathematician and understanding, I will often ask the question, so if we were to make a one-time bet on the flip of a coin, heads you win, tails I win, and we're going to make a bet, and every time you win the bet, you get twice what we bet. And if you lose, you pay me. So if we bet $10 and it comes down heads, you get 20. If it comes down tails, you get 10. I get 10. Would you bet $10? And some people will say no. Most people will say yes. Well, how about $100? Some will say yes. How about $1,000? How about $10,000? Comes down head, I pay you $20,000. Come down tails, you pay me 10. Would you do that? How about $100,000? Come down head, I pay you $200,000. You pay me $10,000 if it comes down tails. How about $1 million? And what I found is that is generally a fairly good predictor. When people give me an answer and say, I would do $1 million, I know that's a very, very aggressive person. If they say I won't do 10, I know that's an ultra conservative person. In general, and it's not 100%, but when I give them that example, most of the times they'll come back and say, yeah, that's pretty well my risk tolerance. And it tends to be their risk tolerance through good times and bad times.
But what that fails to address is the emotion behind it. What if this guy that said he would bet $1 million was a gambler and he had just gone up to the Snoqualmie casino and he had made, a couple of $1,000s and he's riding a high, right? There's an emotional aspect behind that tolerance. That's what I feel is failed to be quantified, right? It's like, how is that person feeling in that particular moment when you ask them what their risk tolerance is, right? Are they riding a high? Are they down? Like, where are they at, right?
This is a person that put $400,000 with me in 1991. Took $13 million out of the account, and it's still a couple $1 million. I mean, it just. On the other hand, we have accounts where they're ultra conservative, and a good portion of the accounts in bonds. They're nowhere close to betting even $100. And I think everyone has to have their own risk tolerance. There's nothing wrong with being ultra conservative. There's nothing wrong with being ultra aggressive. It's where you fit and where you feel. I think trying to fit somebody onto a questionnaire, as you said, Al, you want to do technology, you don't want to do technology. It doesn't really matter what you do. It matters what the upside and downside is.
And, it's like, is this money they can afford to play with? They have time, right? That's another thing is time. Time's a big factor. If somebody needs the money tomorrow, they have no business being in the market.
Or if they need it for a down payment on a house
Yeah.
in 6 months,
Yeah.
you're not going to take high risk.
No. You
Yeah.
put them in T-bills and call it good.
Yeah.
I mean, but that's, a lot of people got burnt. Like one of the scams years ago was we three of us have talked about reverse mortgages stuff. One of the old scams out on reverse mortgages, and they ask you on the reverse mortgage question, what are you going to do with the money? They want to know because people were taking the reverse mortgage and putting it in the market. Right?
Yeah.
And then all of a sudden now this guy, and there was the old crappy reverse mortgages that weren't like they are today, just making huge commissions on annuities and, life insurance policies by putting people in, and then, put them in variable policies, and the policy tanks and the costs go up and they lose everything, and they're like, okay. So
Yeah. So risk is an important aspect of understanding where you are and how much risk you can tolerate. Take too much risk and you can't sleep at night. Take too little risk and you end up running out of money.
Mm-hmm.
So it's an important aspect to know where your risk tolerance is and what your objective is in the long term. And you don't have to do a big computer printout to know that. It's a pretty simple, straightforward question. Anyway, we're coming to the end. We want to wish you a very wonderful rest of the weekend and a wonderful week coming ahead. We've had a lot of fun doing this. I hope you've had some fun and have learned something, because a lot of times what looks so logical and so reasonable just doesn't work. I hope that's a lesson that came out today. Have a very